Good morning, everyone, and welcome to the Sirius Report. Well, Paul, there appears to be a threat that very few people are talking about that is in many ways now worse than in 2008 when it nearly collapsed most of the global financial system. This threat, of course, is housing bubble 2.0.
Yeah, absolutely. And I think it's fair to say it certainly is the biggest US housing market crash since 2008 looms. There's a lot of data to support this. I would say before we get into that specifically, I've certainly been tracking data in Europe, in the United Kingdom, and in other markets. And there's definitely an indication also of this starting to happen. And it always generally starts to become a problem in major cities, capital cities. That's where it kicks off first, then it tends to spread elsewhere. And that's definitely happening already in even countries like the Netherlands, which historically, of course, is has a housing market where it's a large population, there isn't many houses, and you would expect that to be one of the last markets to start to be affected, but it isn't, and it's becoming more and more widespread. Also in the UK, particularly, starts off, of course, in places like London. But obviously, there is significant amounts of data out there if people want to assess it that shows that in the United States that house prices are actually now projected to be falling in probably 50% at least of the country's largest markets, which definitely is indicative that a housing crash is on the horizon. Now, when we say on the horizon, let's be honest and objective about this. It doesn't mean necessarily it will happen tomorrow. Rather like 2008, I saw problems in 2006, and subsequently, of course, 2 years later, it came to pass. But equally, that doesn't mean that what we're talking about today is indicative that the problems are going to continue for the next 2 years. Because there's no doubt that in the US, you're starting to see it becoming a buyer's market, in inverted commas, because those people selling the houses are dramatically reducing the prices and or not only reducing them, but at record late rates because they want to try and suck in buyers who, of course, are very concerned about rising mortgage rates, which ties in again with this whole issue of what's going to happen with the US interest rates going forward. And we're not here to discuss what Fed policy may or may not be, but also there's a lot of uncertainty because of Trump's tariff policies and what that's going to do to the economy, and also broader problems and uncertainties with regards to the US economy. But certainly, there's data circulating. Just in one example, in July alone, there was basically nearly 28% of listings cutting prices. And that's the highest rate I've ever recorded. This related to Zillow's monthly data going back to 2018. And therefore, if you look at year on year prices, they're falling in 25 of the 50 largest US cities. So it's not just, oh, it's happening in New York and, maybe it's happening in Los Angeles or something like that. That is a significant proportion of nations. And a lot of them were actually located in the South and West. So states like Florida and Texas were having significant problems with prices falling anywhere between about 4 and 6, 7%. So, these are situations, okay, it's not in of itself indicative of a meltdown, but when you start to see this number of cities affected and what is going on, the argument is we're certainly going from what we saw during the pandemic years when the housing market, stupidly, of course, prices start rising, and it's now becoming a situation where prices are clearly starting to fall. And the argument is, well, to what extent is this going to become a permanent feature, and is it going to spread throughout all of the United States? And then at some point, the argument is it becomes a housing crisis. And of course, along with many other potential problems that exist in the financial system in broader economies, because rather than just being a single problem as we saw in 2008, we're now in an everything problem. And I think there's certainly data to also suggest that a subprime crisis, again, is on the cards and worse than happened in 2008, because the subprime problem, rather like all the other problems, was never dealt with, never went away. It was just, you know, dealt with in a way that gave everyone a lot of ridiculous confidence in something, and it's clearly in the last few years become also more of a problem again. And we've seen a lot of evidence of this, where people are being given mortgages in under absurd conditions, where they should not qualify for a mortgage, and certainly not 100% plus mortgages, as and all the kind of crazy things that went on prior to 2008 and caused, in inverted commas, amongst many other things, because it wasn't solely this, but linked to the subprime crisis, which contributed hugely to the problems that we saw in 2008.
Yeah, it's kind of interesting you mentioned about you Britain. London was pretty much the canary in the coal mine, because if you remember, Northern Rock pretty much was the big signal that started about 2 years before we had the ultimate collapse in September, October of 2008. So these things really, for those who are paying attention, are going to be able to be seen a year and a half, 18 months to 2 years before the final reckoning happens. And when we talk about the fact that, and mention this, and imply strongly that things are worse off than 2008. One, home prices have exploded to monstrous points. And what that does, of course, is that people, ever since especially 2015, 2016, those who bought in 2009, they got a steal, because home prices went from down 40 to 60% from their highs in 2008 to their lows in 2009, 2010, the same way the stock markets did, the same way many other financialized assets did. But when they started doing QE and really started kicking in this cheap credit and cheap capitalization, and for those who saw the movie The Big Short, yes, Wall Street did go back to selling CDOs, CLOs, and MBS to exorbitant rates. The problem is that many of the people who have been buying homes, and the pandemic was a big catalyst for this. Many people who've been buying homes have done so at near all-time high prices. So they can't sell to people who no buyers can afford them. And if prices go down, they're going to lose money, which means it's going to be a short sale or a foreclosure. And this is why we're starting to see more and more. This came out from Goldman recently. Adjustable rate mortgages now are up to 41% of all loans, because people can't afford at the higher rate of what is it today? I pulled up the numbers for today. 6.3 to 6.7% for a 30-year fixed. So anybody who's buying a home in any capacity, 40% are doing so with adjustable rate mortgages, which are one of the big things that really led to the crash. The other thing is because there's two big delimiters that are different today that we didn't have in 2008. One, individuals buying homes are doing so, at least in the United States, at the oldest age ever, 38 years old, to buy your first starter home. So nearly you're almost entering middle age before you're buying your starter home here in America. The second thing is inflation. Everything that has to do with the home and with living, standard of living, is now extraordinarily higher. I mean, obviously, home prices are higher, but the ability to pay for maintenance on your home, the ability to pay for property insurance and homeowners insurance are much higher. So everything, the entire cost of the of owning a house is extraordinarily higher. So those who own can't afford to sell because they're going to lose money or end up losing in a short sale. And those who want to buy, now everything's unaffordable. And what happens when you start having stagnation in the housing market? The housing is the biggest true industry in America. As housing communities get built, then other businesses get built around it, schools get built, more people come in the whole night, and you create an ecosystem within that, which brings in more consumers. And Americans' whole economy is built on consumption. And if people are spending nearly all their money paying for a home, paying for insurance, paying for the basics, then they're not buying goods and services, which are going to absolutely collapse the GDP to begin with.
Yeah, absolutely. And it's also on the flip side, there is a bit of a puzzling contradiction because there are areas in the United States where there are house prices rising slightly, maybe 3-4%. But what's very telling with regards to that is it's a lot lower than all the double-digit growth you saw during the course, ironically, of the pandemic, sort of 2021, 2022. Now, the question is that sustainable anyway, going into the future? But I think what you will continue to see, and inevitably, is if the Trump administration gets its way and actually tries to have interest rates lowered, in the end, that will just lead to higher and higher mortgage rates. It sounds contradictory, but it's not, because what this will do is it will create more and more inflation in an economy that already has inflationary problems, and that is being exacerbated by all the idiotic tariff policies. So if you end up with interest rates rising higher and higher, and as you can rightly point out, and 41% of people on variable rate mortgages, they're going to start massively defaulting on their mortgage. They won't be able to pay them. Never mind that what happens in the real economy is people lose their jobs and therefore they start defaulting because they can't pay the mortgage anyway. And the criteria for people getting mortgages is becoming more and more ridiculous. And that's certainly happening not just in pockets of the United States, but it's also been happening in the UK and across Europe, etc. Then, no, the argument is we are likely, as far as interest rates go for home ownership, they're not going to start to fall. They're only likely to increase. The economic situation is going to worsen. And more people will start to lose their job. And this is why a lot of the jobs data just doesn't stack up. And then it gets revised down significantly. And we've spoken before about concerns to do with the job market. And I think the argument's going to be, okay, let's see to what extent house prices continue to fall. And, are we going to see over the course of a calendar year, or however they measure the metric, the US house prices will fall by whatever percentage across the board? And if that happens in this year, that'll be the first time it's happened in basically 15 years. And people might say, well, that's not indicative of a housing crisis. Well, the thing is that with things being the way they are and what happened during the pandemic, which created an awful lot of leverage and margin and problems in the housing sector, it led to an awful lot of properties for some weird reason being built. And now they've got no one who wants to move into them. We know there's big problems in commercial real estate as well as the retail sector. And it's worth noting if we get a dip in this year, that's going to be in stark contrast also to predictions where there was people thought there was going to be 3-4% percent growth. If you get a contraction of 1 or 2%, that's a big shift. And it can be, in essence, the catalyst for a housing crisis. And also, of course, this depends on, as we said, what happens with interest rates and what happens with mortgage rates as a consequence of this, and all the other problems that exist in terms of the economy and the financial system. And it's not just an issue, well, we have a problem in the housing market, and we in isolation you might be able to deal to some extent with interest rate rises to a point, but not when you factor in all the other problems that exist in the economy, and not least what is going to go on with tariffs, and how there's now a recognition in terms of tariffs that the consumer is going to start having to pay whatever the percentage is that ultimately comes out of this. And it's not going to be the exporter to the United States. That's clear that it's not happening already. So there are many factors to contend with that are going to impact the broader economy, the broader financial system. But there is enough evidence to suggest that housing markets are changing, and they're going to change quite markedly. And there is therefore every reason to suggest that a major housing crisis is absolutely on the horizon.
You know, one interesting final thing I want to go ahead and add to this. We're talking about the fact that they kick the can down the road and that financial and economic conditions are not only so much different than they were 15 years ago, 17 years ago in 2008, but they're even worse. We're not just talking the debt levels, we're not talking the debt to GDP levels, we're not talking the financialization, where we've seen commercial real estate in many places collapse. We've seen some of the banks really lose their foundation stability. We've also seen where tens of thousands of different small businesses have completely closed because the banks are no longer lending for small businesses. It's corporation or go home, it seems like, whether at the banking system or even from government assistance. But this unprecedented inversion, it has never cost more to buy an existing home rather than a new one. So this means that it's when people are looking to buy a new home, they're going to be looking primarily for new, where they're going to get the best incentives, and they're also going to probably get more self-financing, which will help them if they're going to go ahead and do this. This means two things. One, those who have existing homes, everybody else in the world, they can't offer those incentives, and they can't afford to have the cost go, the selling price go down very much, or they lose it and they end up in a short sale. The second thing is that if you're relying on new homes, well, it's not like you have these plots of land everywhere you want to live. If people want a new home, more likely than not, they're going to have to move, whether it's to a new county, to a new city, to a new state, to be able to afford to buy a new home. And then, of course, you got to worry about it. Is there a job there for us? What's the standard of living, et cetera? So we saw during the pandemic where millions of people left some of the higher priced areas like New York, Illinois, California, et cetera. Now they've inundated a lot of the places that were able to take them in, but they really, because it also drove up home prices because you had individuals coming in who could afford then to purchase existing homes, but they can't afford to now. And those are going to be stuck. They're not going to be able to sell. And, at a certain point, when does this really hit upon the derivatives like mortgage-backed securities, CLOs, CDOs, et cetera, where Wall Street, which no longer has the backstop of the reverse repo, now they're going to have to pay the cost for their leveraged and margined uh, investments. Paul, any other final thoughts you wanted to add to this?
No, I think that's fine. I think that's plenty on the subject.
Yeah, it's certainly not. We're going to have this happen tomorrow, but we're starting to see many of the canaries that we saw in 2006 that people ignored that almost led to the complete collapse of the financial system. So just want to make sure everybody's awake and aware. Paul, as always, thank you for being a part of this discussion and for your insight.
Yeah, and likewise.
And to everybody here at the Sirius Report community, as always, thank you for your support. Don't forget to like, share, subscribe, comment, send this out to anybody you think it might be important to. And until the next time we get together, have a great day.